I'm Connie Saunders, and I'm a California realtor and manager of Foreclosure Freedom Network. I've been in the mortgage industry for 20 years, working with the lenders most of that time, and because of this, I can understand both lender and homeowner points of view. There's no advantage, actually, to force you out of the home in most cases. The literal flood of properties onto the market because of foreclosure and pre-foreclosure sales have caused an avalanche of lowered home prices on the market, forcing the prices down and down over time. Now, some lenders or investors who are in trouble may prefer to get some capital by way of getting a foreclosure cash, but the process is not quick. And by the time the fees are deducted, the underlying investor in many cases has 45 to 60 cents on the dollar or less. So why shouldn't they take a chance on you? In California, the state legislators have decided that lenders foreclosing under these circumstances actually violate Article 4 of the Constitution. Why did they think that? I quote, "This act is an urgency statute necessary for the immediate preservation of the public peace, health, or safety within the meaning of Article 4 of the Constitution." Now, this certainly applies to the entire United States, doesn't it? I also believe that when a lender doesn't modify a loan for somebody in trouble on their home loan, when the net present value of the modification is greater than that you could get from foreclosure, that violates the Fourth Amendment of the Constitution, the right of the people to be secure in their person, houses, and effect against unreasonable searches and seizures. It's certainly unreasonable when the lender can get more from them than they can from selling this in foreclosure and using that money for whatever their purpose is. It's really just a fear of a precedent being set, I believe, that's causing the argument on this. But having more and more foreclosures on the market forces the prices down. That's pretty obvious. And that could be avoided if lenders simply modified these loans with something that is reasonable, with closer to current market value. Freddie Mac says the cost of the average foreclosure is $60,000. When you deduct the foreclosure cost, then you can reduce principal down to current market value rather easily. And therefore, that would be a huge breadth of people that they can then give loan modifications to that they're not offering loan modifications to now, because once they have to reduce principal, they don't want to. So they also don't want to go down in low interest rate, usually to the 2% that they should be going down to. Some lenders have fought this step every step of the way, B of A, with the exception of Wells Fargo, who is very eager to move forward on this. Most other lenders are participating in the objection side of things. Now, lenders have a lot to do with this crisis the way it is, such as their automated underwriting. When that came into effect, loan officers, senior loan officers, were advertising far and wide that you could get stated income loans, and in actual fact, when they were doing the applications, they would cheat their own internal underwriting system by putting in false data into the system. On a stated income loan, you don't need to have full docs, so that would never get caught. Now, there's the Zippy cheats and tricks, and Zippy is the proprietary underwriting system JP Morgan Chase has. That cheats and tricks memo went out from a senior loan officer to all of their underlings, and they were encouraged to, quote unquote, cheat their system from time to time. And this was primarily at the tail end of this bubble. But here's a quote from that memo, so you can get an idea of what was going on. "If you get a refer," which basically means that the loan file now has to go to an actual live underwriter for a view, or if you don't get stated income or stated asset findings, then, which means basically you have to have documents of your buyer's asset, never fear. Zippy can be adjusted ever so slightly. So that's kind of scary. And they were doing that for loans all over the country. They basically told them what the various thresholds were for every field. If it's higher than this, lower than this, they'll qualify. Otherwise, if it's outside of these windows, they're not going to qualify. So basically, once the loan officers really knew these triggers, quite often the more honest, or the who knows, many of the loan officers would ask people pleading questions such as, you make more than this, right? Or you make less than this, right? I'm sure a lot of you know that you had loans and loan officers that were like that and prompted for what would make it all work. So, you know, and people basically felt exaggerating in favor of an acceptable loan, and they wanted this loan. They planned to pay it back. That was fine. So everybody was involved in that one. And another one that even came, that's a much bigger reason, involves subprime products for affordable housing. It used to be that Fannie Mae and Freddie Mac side-checked the mortgages that were purchased in order to ensure that the people were generally qualified for these loans in the underserved markets that they were serving with the affordable housing loans. And they made sure that, first of all, they were in that category and that they were making money, that they could pay the loans back, etc. Basically, prior to this point, there was redlining going on where imaginary lines would go around a certain neighborhood by lenders, and they would discriminate against giving loans. And whether they said so or not, those people would get a lot less loans. So to wipe that out and help account for that and balance that, Fannie Mae and Freddie Mac every year were supposed to buy portions of their portfolio that were specifically for these specific areas or specific underserved borrower public, a certain defined public type, ethnicity or whatever. And every 4 years they would review what their criteria was in order to adopt changes or keep it the same depending on what the market was doing. Now in 1995, Clinton agreed to let Fannie Mae, Freddie Mac get affordable housing credit for buying subprime securities. And that included loans, now, securities is a lot more than just a mortgage. Basically, you don't even have the underwriting going on there. So there's no oversight. Fannie Mae, Freddie Mac, who were overseeing the mortgage process, are now not participating in that on these loans. They're just simply buying these securities. And, of course, there's just absolutely no way they're going to, in that case, be qualified or able to go all the way down the chain on that kind of disclosure. So, basically all side checking of that went out the door. And a lot of the people that were loaning on these kind of subprime mortgages were people out of the country. UK, China, Germany, Deutsche Bank, all of these places that have huge loan portfolios on U.S. properties or huge amounts of securities for their trustees, for their trustors, for their people that they were getting these loan pools for or securities for. That they were all outside of the United States. So their standards on underwriting were completely out of our control. So basically, when you have this kind of a migration of these toxic loans onto the securities market and being sold as securities, and a lot of these securities were rated differently, priority rating or good rating, bad rating, and of course that would change the amount of percentage of return on portion of the loan. But all of these were in serious toxic level quality after a while, with no oversight really happening. And of course, loan servicers didn't have the opportunity to oversee this. So back at that time, there were major players that anticipated this, that warned people of this, and those warnings were completely ignored. And in fact, no warnings, even in 2006, were heeded until they could see that actually the actual volume of sales and the increased prices of homes were continuing to steadily increase. Once that stopped, then all of a sudden people started to freak out. But